Today, I'm going to share 3 critical ways to manage risk in your retirement portfolio. Whether you're fully invested or you have cash that has been sitting on the sidelines, I personally believe that you have more influence over your investment outcomes than you are being led to believe. Now, the process and tools I'm going to go over today are influenced by my personal beliefs about investing, but I do believe that they can help you deploy your cash, reduce risk, or shield from volatility. But it all begins with an understanding of some basic investing concepts. So the first way to better manage risk is to establish a better understanding of risk itself. General retirement investing wisdom has us think and feel like risk is binary. Something is either risky or it's not risky. And asset allocation, the concept, reinforces this idea that risk is binary. Because you either have money on the risky side of the allocation or you have money on the safe side of the allocation, i.e. a 50-50 asset allocation would, I guess, indicate that 50% of your money is in risky investments and 50% of your money is in safe investments. Now, this is painfully false. I suspect most people, including you guys all watching this video, know that that cannot be the case, and yet most people still use asset allocations and are still uncomfortable with them all the same. And I think that's because most of us don't have the words to put to that subconscious understanding that risk is not binary. So today I'm going to provide you guys with a reframe of the concept of risk. See, risk is a spectrum. There was this amazing movie a couple years ago called Free Solo, and it followed this rock climber named Alex Honnold. And this guy climbed 2,000 plus foot walls in Yosemite National Park without ropes, right? He did it completely free. And in one of the interviews in the movie, he was asked about his view of risk. The interviewer said, are you depressed? Are you suicidal? Do you have a death wish? Because the interview wanted to know, what could possibly make a person take such great risk? So the rock climber, his name was Alex, so he very calmly and collectedly replied something to the effect of this. Now, climbing this wall isn't actually risky for me because we need to redefine risk into 2 parts. There's risk, which is the probability of something bad happening, and then there's consequence, which is the magnitude of the bad event. So Alex continued by saying something like, I've climbed that wall thousands of times over the course of my life with ropes on. And every night before preparing for this event, I wrote down every handhold and every foothold and the exact sequence of the moves that I was going to do on that wall. I knew exactly what handholds I needed to do that were shorter, what were longer, what was I not going to skip because I had no ropes on. And he said, that wall may have high consequences, meaning yes, if I make one wrong move, I fall to the floor 2,000 feet below and I die. But that wall actually isn't risky for me. I know it like the back of my hand, and since watching that, I, Eric, have specifically reframed how I think about risk, especially when it comes to investing. See, it's actually quite helpful to think of risk and consequence together as 2 components of the same element. Risk is the likelihood or probability that a bad event will happen, and then consequence is the magnitude or the impact of that event. So let me use a real-life example that we'll all have experience with, right? Flying on an airplane. See, air travel is what we would call a high consequence, low risk activity, right? If the plane goes down, you're very likely to have a fatal experience, but planes don't go down very frequently, and therefore we all think of this as a low risk activity. But the first person who ever flew on a plane would undoubtedly have thought that this was a 10 out of 10 on the risk level, meaning high probability of a disaster, and a 10 out of 10 on the consequence, meaning a high likelihood of death. But what happened is, as more people flew on planes and air travel technology got better, we got more evidence that the experience was not actually highly likely that things would go wrong, despite it being high consequence. And now we all fly on planes everywhere we go and think of this as a completely normal activity, right? The accumulation of historical data helps provide a framework through which normal consumers like you and I can view an activity that might look extremely risky to the uninitiated or the less educated, things like driving a car or flying on a plane or even starting a business. And that historical data can help us understand the risk level and the probability that something bad will happen, but also the consequence level, meaning the magnitude or the impact of that bad event. So now, armed with that knowledge, we can dig into some core investment concepts that lead to bad investor outcomes and replace those concepts with proactive methods to manage risk and consequence. So how do we take everything I've talked about so far and make this practical? We already highlighted how asset allocations frame risk as a binary, and we want to do away with that type of thinking. So let me use a real-time example of an investment allocation that layers in this new way of thinking about risk and consequence and should cause us to question the use of asset allocation. So say we have 2 people, each with $1 million in a 60% stock, 40% bond portfolio. So they each have the same amount of money. They each have 60-40 portfolios. Person 1 has the entire stock side of the portfolio in just one company, Tesla stock. And person 2 has the stock side of the portfolio in a basket of 30 individual stocks. So the question is, which of those people has the riskier portfolio and which will have the more consequential portfolio? And the truth is, without knowing what that second investor, the one with 30 stocks, holds, we actually don't know that it's any less risky or any more less consequential. But conventional asset allocation wisdom would tell us that just by virtue of the fact that that person holds 30 positions, meaning they are less concentrated and more diversified, that person two's portfolio would be less risky. Both portfolios are in 60-40 portfolios, but really the truth is the only thing we can say based on asset allocation is that neither portfolio is clearly riskier or more consequential than the other. Holding 60% of your funds in only Tesla stock will certainly have a high likelihood of negative outcome than holding 60% of your funds in a Vanguard Value Exchange Traded fund. But so too could person number two's portfolio, the one with 30 individual stocks, be high risk and high consequence. What if they're holding 30 single stocks that are all small cap companies that show no profit and are completely debt reliant? Right? The issue here is that on the surface, both portfolios appear to be the same. They both have 60% weightings to stock, and in an asset allocation, a financial planning tool, they would look like the same portfolio if you didn't look beneath the surface. But it's obviously the case that not all stocks are created equal in terms of their potential risk and their potential consequence. Now, the same is also true for bonds, and just because I didn't give an example doesn't mean it's not true, but it is actually true. So while asset allocation can sometimes be a useful tool, it's actually really not all that useful in my opinion. This is why, despite constant reassurances by the internet or brokerage companies and even investment advisors, you may still lose sleep at night about your investments despite it being in quote unquote the right asset allocation. So what proactive data points can we use to help provide us with the evidence or knowledge of how to identify the risk, the likelihood of a bad outcome of an investment such that we can actually sleep well at night with our retirement portfolios? Well, I believe there are many options, but I'm going to share 4 of my favorite measures. And those 4 are concentration, exposure, variance, and correlation. So concentration tells us how much of our funds are held in one single investment. So we've all heard the cliche, don't hold all your eggs in one basket. That's undeniably true. And using that example of Tesla investor earlier in this video, that would be an overly concentrated portfolio, which increases both the risk and the consequences of the holdings. But say that person were to hold 60% of their funds in a money market fund, right? That portfolio is also still too concentrated, even though most of us wouldn't think of it as risky, but it does have high levels of consequence and risk as well, because it is both extremely likely that a person will have tremendous opportunity cost on the gains they miss out in the market, but also tremendous difficulty getting back into the market, right? We don't think about that too often, but it does make that risky and consequential. Now, the second tool that we can use is what I said earlier, is exposure. Exposure layers on top of the concept of concentration. And exposure gives us a direction as to how much of a certain investment we want to hold in our portfolio. Increasing or decreasing exposure to certain investments or sectors can help us enter the market if we have too much cash, or it can help us reduce our risk by reducing exposure if we're already invested in the market. So for example, say you have 60% of your funds in money market and you want to figure out how to get from there to investing your funds into the stock market. Well, you can start by giving yourself low exposure to a wide variety of investments and then slowly increase your exposure to the riskier investments over time as a way to get from point A to point B, kind of like playing a game of Frogger where you hop lane to lane to lane to get across the street. And the third tool at our disposal that I mentioned earlier is variance. So variance is also known as standard deviation, which is a statistical measure that tells us, using historical data, what's the range of values that an investment might trade within. The higher the variance, the wider the range, and therefore the more variability in the price of the investment. So that means you may get higher rates of return, but you need to take on more risk in order to participate, because if you want that wider upside, you're going to have to accept wider participation to the downside. And we have historical data that can give us estimates or expectations of the variance of particular investments so that, again, we can manage both the risk, meaning the probability, and the consequence, meaning the magnitude of bad outcomes in our portfolio. And finally, the fourth tool is correlation. Correlation tells us the likelihood that an investment will travel in the same direction as the overall stock market. It doesn't tell us anything about the magnitude of an expected move, so it won't tell you how much it will go up or down if the stock market goes up or down, but it can give us some idea of the direction. Now, stocks and bonds can have wide-ranging levels of correlation to the market as a whole. Some stocks are not actually all that correlated with the broader stock market, market. And in fact, some bonds are actually highly correlated to the stock market, right? So this idea that bonds have been inversely correlated to stocks and therefore holding bonds is some kind of a diversifying effect to stocks is partly true, but you have to hold the right bonds. And some bonds will act more like stocks and some stocks will act more like bonds in terms of the correlation benefit they provide an investment portfolio, which again is one of the reasons why asset allocations are actually really tricky and can oftentimes be misleading. But historic data can provide some expectation of which stocks and bonds have what levels of correlation to the market so that we can construct a retirement portfolio that again manages risk and consequence. So the key concept I'd like you to take away from today's conversation with myself is that just like rock climbing will appear highly risky to someone with limited experience, investing feels risky and highly consequential to those of us with little experience. And rather than just throwing caution to the winds and using an asset allocation or a 3-fund portfolio or some random basket of index funds because we're told that's the right way to go, my opinion is that we should invest some extra time and energy into obtaining a better understanding of investing, because that's what's really going to provide the peace of mind that most of us are looking for with our retirement portfolios. Now, I'm not telling you all to go out and become an investment expert. You don't need to spend 1,000 hours learning about this. In fact, my advice is quite the opposite. Go find someone who actually is an expert. And then what you can do is put in some of your own time to at least get a baseline level of knowledge like what we've talked about today, so that you can interview the proper professional and hire them if it's appropriate. But at least based on the information I've shared with you today, you'll have a better idea of what to ask a professional. You can better qualify them by asking them questions about what they would do with your money beyond simply asset allocation. If an investment advisor or a professional can't explain concentration and exposure and variance and correlation of the specific portfolio and investments they would recommend for you, then it's likely that they know just as little as you about those matters. All right, so a couple quick notes as I round out this podcast here. The first is I could really use your feedback. I love this topic, and I was thinking of turning this into a more spreadsheet-heavy demonstrative style of video that would go up on the main YouTube Saturday videos with kind of visual explanations and examples. And the question I have for y'all is, would that be of interest? And if it would, please leave a comment below or send me an email. Let me know if you'd like to see this idea in a more detailed version in a future video. Secondly, if you like this idea or concept, I have a whole series of videos on my YouTube channel called The Asset Allocation Problem, where I've discussed modern problems with retiree portfolio management. I really recommend you head over to the channel and watch that playlist in its entirety. It's probably about 45 minutes. Finally, if you'd like to learn more about how we help our clients build confident retirement plans and investment strategies, you can visit our website at www.thepeakfp.com. Thank you as always for your time and attention, and see you in the next one.